Hello friends, how are you? I hope all of you are doing really good. So welcome to Economics or Finance Excellency batch. Okay, before I start with this lecture, first of all, I would like to thank each one of you who has been an integral part of KSJ Teaching, because where we are today, it's all because of you people, and you people have been contributing a lot, right? A lot of people have been contributing by the way of sharing the lectures. Many people have been contributing by the way of buying the handbooks, and so there is a very special segment that is contributing by the way of voluntary contribution on our website. So thanks to each one of you. And there is a huge set of students who is watching these lectures, and that is the major contribution, that you people are loving the content, and it's all because of you people that gives us the motivation to be here, to be doing something special for you guys. So all because of you. Thank you guys. And please stay connected even when you become the chartered accountants or the professionals, whatever the course you are doing. We would really like to be connected with you guys, because it's a family, and the links always continue. Okay, so let's continue with our topic, that is Keynesian theory of national income, that we started it in the last lecture, and I hope all of you are enjoying it. All of you have understood, most importantly, beyond enjoyment, most importantly, what is important is that you people have understood whatever we have covered so far, right? So let's have a quick recap of what we have covered so far. The Keynes gave us the theory regarding the national income, right? That how this national income, what are the various contributory factors to the national income, what are the various behaviors. The calculation part we have already done in the first chapter, where we have discussed about the national income computation and accounting and all those things, GDP at MP, all those things we have already covered. Now, what is the theory of Keynes? Keynes has given three different models for that. One is the two-sector model, that is household and business, three-sector model, and four-sector model. So we started with the two-sector model, that how there is a circular flow of income in a two-sector model. Two-sector model, as I told you in the last lecture, is quite an hypothetical model, because practically existence of it is not possible without the government, right? That only and only household and business sector is there, but still there is some circular flow of model. What is that? The households provide the factor services to firm, and firms using those factor services manufacture the goods and services, right? And for the factor services which the firms have received, the firms will pay the factor income to the household, and the households, the factor income which they are receiving, they are doing the expenditure by buying the goods and services manufactured by the firm. So this is how the whole flow will continue, right? So we discussed about this. We discussed about equilibrium in the context of an economy, that what is equilibrium? When the demand is equal to supply. Whatever is demanded in the economy, exactly that thing is supplied in the economy, right? Let's say you wish to have three chapatis. Your mother is making exactly three chapatis. That's it, right? So that is demand and supply. You are demanding three chapati. Your mother is supplying three chapati. That is an equilibrium part, right? That we have already discussed about. Then the aggregate demand function we started with in the last lecture, that what is an aggregate demand function? That what is the total demand for goods and services in an economy in a given period of time. So when we talk about demand, the demand can be for the consumer goods. What are consumer goods? The consumer goods are the day-to-day routine usage goods, right? And they have the major contribution in the GDP, because these goods we buy on regular basis for consumption. The second category is the investment goods, right? Investment goods in the short run, they remain constant. Why? Because we do not invest on these goods on the regular basis. Do you buy car every day? No, sir. But do you buy fruits and vegetables every day? Definitely, sir. Right? So investment goods in the short run will remain constant. That is why this investment good I, we put a line here. When we are talking about the investment goods, we put a line here that shows that I is constant in the short run. Okay. Now we have discussed about this demand function, and we say that this one component is the aggregate demand for the consumer goods. That means we are consuming something. In relation to this, there is a topic, that is the consumption function. What does this consumption? Sir, you have income, right? You got some money, you are doing a job, you get some money out of it, right? Now, what will you do with that money? Sir, obviously, you will spend that money, right? You will spend that money on buying some goods and services. Now, this is a very important topic that we are starting with, right? So he says the consumption expenditure expresses the relationship between the aggregate consumption expenditure and the aggregate disposable income. We have studied something about the disposable income. Just try to understand. Try to understand. You earn, what I'm saying is, you earn 10,000 rupees, right? On this 10,000 rupees, you pay some direct taxes. You pay some direct taxes. Let's say 1,000 rupees. So what is the money that is left with you? 9,000. So this 9,000 is what? This 9,000 is your disposable income. Is your disposable income, right? And when we discussed about this two sector model, in the two sector model, we say there are no taxes, nothing as such, right? So what is there in the two sector model? He says in the two sector model, if your earnings are 10,000, if your earnings are 10,000, which is denoted by Y. Y means the total income, right? Y means the total income. He says there are no taxes, nothing. Whatever you are earning, you are able to spend that. That means what is your disposable income here? What is your disposable income in this case? Sir, your disposable income is 10,000. Right? I denoted by YD. That is out of the total income, what is the disposable income? So I can say in a two sector model, Y is equal to YD. That is whatever total income that you are earning, that is a disposable income. Sir, how do we get to know this? Read it very carefully what we have done. Here we have, see this point. With a factor income so earned is spent on buying all the final goods and services produced by the business firms. Now, if you're spending money, that means you have a disposable income, isn't it? You have a disposable income. That is why you are spending that income. If that is not a disposable income, you are paying the taxes. Can you spend whatever you are earning on buying the goods and services? No, sir. Right? So from here, what we are getting to know is that in a two sector model, this Y is equal to YD. This is your total income. Total income. And this is your what? Disposable income. Now just let me know one thing. This is your disposable income. Now let me know just one thing, sir. What, sir? What do you want to know, sir? I want to know, let's say you have a disposable income of 10,000 rupees. How much consumption expenditure you can do? How much consumption expenditure you can do on consumer goods, right? Because the investment goods are constant in the short run. So what I'm saying is that if you want to buy the consumer goods, how much of the consumption expenditure you can do? Sir, we can do it only up till the disposable income. If you have 10,000 rupees as disposable income, we can do this consumption expenditure only up to what? Only up to disposable income, right? So from here he says consumption expenditure is a function of income. That means whatever income you have, you can consume only that much, right? Beyond your income, you cannot consume anything. That is for sure, right? So this is what is written here. Let's see the consumption function here. He says the consumption expenditure expresses the relationship between aggregate consumption expenditure and aggregate disposable income. Whatever the disposable income you have, only that much you can spend. So C is equal to Fy, where C is the consumption expenditure and Y is the disposable income. And we can also write it as YD, as I just told you that in this case, total income is equal to disposable income. And this equation shows us that consumption expenditure as a function of disposable income, right? C is equal to Fy. When I write it that consumption expenditure is a function of income, that means C is equal to function of Y, right? Or I can also write it as C is equal to function of YD. It means one and the same thing. When we are talking about the two sector model, we are just focusing on one thing, that is the two sector model. The scenarios will change in the three sector model and the four sector model, right? Right, sir. So he says the private demand for the goods and services accounts for the largest proportion of the aggregate demand in an economy. What is private demand, sir? What is private demand? Private demand is demand for consumer goods, that is your private demand, and accounts for the largest proportion of the aggregate demand in the economy. This we have already discussed, right? Because the investment goods remain constant in the short run. It is the routine things, the vegetables, fruits, right, the clothes that you require in the daily routine, and that is what people are manufacturing more in an economy, right? Because you require more, people will manufacture more. Okay. After that, we say, according to Keynes, the total volume of private expenditure in an economy depends upon two factors. That how the people will do the private expenditure, that is dependent upon two factors. One is the current disposable income of people, that is the total money in the hands of people. That whatever the people, if the people are having 10,000 rupees, obviously they will be able to spend on the consumer goods 10,000 only, right? And the proportion of income people want to spend on the consumer goods, that is out of the total money in hand, how much money people are willing to spend in buying the goods. So here we say that if your disposable income is, let's say, 10,000 rupees, right? This is the disposable income of a person Ram. Now one option is that he can spend this whole of 10,000. Another option is he says, no, I will spend only 8,000 rupees, right? Sir, what about the remaining 2,000 on the consumer goods? Sir, what about remaining 2,000? 2,000 he can save. That is totally his option, right? So Ram has 5,000 rupees in his pocket. This is his disposable income, but he wants to spend 4,000 out of it and save the rest. Therefore, the volume of private expenditure will be 4,000 rupees. That what is the amount that we are ready to spend, consume, right? Consumption expenditure means you are doing some expenditure on the consumer goods, right? That is what is known as consumption expenditure, the expenditure on consumer goods. So if Ram is doing only an expenditure of 4,000 rupees, so that means his expenditure on the consumer goods will be 4,000 rupees. The rest of it he can save, right? So this is the equation. When we are talking about the consumption function, this is the function, that is C is equal to A plus BY, where C is the aggregate consumption expenditure, Y is the total disposable income, A is a constant term which denotes a positive value of consumption at zero level. I'll explain, don't worry. B is the slope of function. Now listen to it very carefully. What is C here, sir? C is the consumption expenditure. So try to understand this graph now. Here on the x-axis, we have taken the income, right? And on the y-axis, we have taken the consumption part, right, sir? Now, what do we want to understand here? We say as the income keeps on increasing, your consumption will also increase, because consumption is a function of income, right? Whatever the disposable income you have in hand, your consumption will be according to that. So if your income increases, your consumption will also increase. Now, if you have 10,000 rupees, you will buy a mobile which is within the range of 10,000 rupees. Tomorrow, if you have 50,000 rupees, you will go and buy a mobile for 50,000 rupees, right? Because your income has increased, your consumption will also increase. Although it is an investment expenditure, the example, it is just an example that I'm talking about, right? What I'm explaining is as your income increases, your consumption will also increase. Okay, sir. C is equal to Fy, we have already understood that consumption is an expenditure of income. As income increases, the consumption will increase. So we say Y it is a function of income, that as income increases, consumption will also increase, right? Consumption will also increase. Now, there is important point here now. C we do, we know, Y we know. What is A, sir? What is A? If you have, this is the zero level of income. This is the zero level of income. At this level, even if you are not having income, will you have food or not? Can you survive without food? You will say, sir, I don't have income, so I want to survive without food. Can you do that? Can you survive without food? No, sir. We cannot survive without food. That means even at the zero level of income, we will have some expenditure here. We will have some expenditure, but you will ask me a point here, sir. Sir, if I'm not having a income, how can I spend on buying my consumer goods? How can I spend on buying the vegetables? How can I spend on buying the fruits when I am having zero income level? That's a very valid question. So in that case, what will happen is, for this A, either you will borrow money, or you will take out your savings. If you have kept some savings, right, it might be in the form of fixed deposit or some other things. So what will you do? That you will dissave, right? That means you will take out your savings, right? Or you will dissave. Dissave means whatever the savings you have kept, you will take out all that for your consumption expenditure, for your survival. That is the A level. A is a constant term which denotes a positive value of consumption at zero level of income. Clear? And what is B? B is the slope. Slope function means that how my consumption is going to change when my income changes. Right? So what is B? B shows the change in consumption. B shows the change in consumption due to change in income. Change in income. Let's say my income increases by 10%. Will my consumption also increase by 10%? We will be understanding that, right? So this is what I wanted to explain. This is the consumption function, that is C is equal to A plus BY. Right? C is equal to A plus BY, where C is the aggregate consumption expenditure, Y is the total disposable income, A is that consumption expenditure which we will have to do even at the zero level of income, right? And B is the slope function. The B shows the change in the consumption due to the change in income. I hope it is clear. Okay, so let's try to read it from here. The consumption function shows the level of consumption C corresponding to each level of disposable income and is expressed through a linear function as in the diagram. According to Keynes, the consumption increases with the increase in the level of disposable income, but at the rate of increase in the consumption will be less than the rate of increase in the disposable income, as some part of the income will be saved by the households. Now, try to understand this point. Try to understand this point, what he wants to say through this particular point. He says, let's say your income is 1000 rupees, right? Your income is 1000 rupees and you want to spend on a particular device which is worth 1000. So what will you do? You will do a consumption of 1000 rupees, isn't it? Your C will be 1000. Now what happened, sir? Your income increased to 2000 rupees. Now that device which you have already purchased for 1000, will you again buy that device only? No, sir, that was just the requirement. Now you have additional 1000 in pocket. You will obviously spend on something, but it is not necessary that you will buy the whole of 1000 increase. Let's say your consumption increased to 500 rupees extra, right? With the increase in income by 1000 rupees, your consumption increased by 500 because you are satisfied with that, what you have. Let's take an example with the real life. Let's say you want to eat 3 chapatis, then what will you do? Let's say you want to eat 3 chapatis, sir. Your mother will bring 3 chapatis, right? Now, what happened? You are filled. Yeah, right. Your stomach is fully filled with those 3 chapatis. Now, mother says, please take one more chapati. I have a special one made for you. right? I have a special one made for you. Please, you have to eat it. Now, what will you do? Right? Either you will upset your stomach, but you don't want to do that because you are a CA student or any professional course, whatever you are doing, right? And you don't want to waste your time in that thing, isn't it? That happens, sir. Now, what will you do? And you don't want to disappoint your mother also. What will you do? Sir, you will take a part of it. You will say, okay, I don't want to eat full, but give me half, right? Your income increased. The chapati increased from 3 plus 1. That increased by 1, but your consumption increased by half only. Why? Because you were already full with the first 3 chapatis. That is the same thing. As your income keeps on increasing, your consumption will increase because you have now more money in hand, but the rate of increase in income will not be same. The rate of increase in the consumption will not be same as the rate of increase in the income. If your income is increasing by 1 lakh rupees, it is not necessary that your consumption will increase by 1 lakh rupees, right? Let's take another example. Let's say you are having an income of 50,000 and you are paying a rent of 20,000 rupees, right? Let's say that you are having an income of 50,000 rupees and the consumption on the rent is 10,000 rupees. Right? Now your income increased from 50,000 to 1 lakh. When your income has increased, you decided that I must be having a good home now for the rental accommodation. Now what will you do? You find out for yourself, you find a good PG or good home, a rented accommodation for yourself. The rent of that was 15,000 rupees. Right? Now what happened? Your income increased by 50,000, but your consumption increased by only 5,000. Right? Because there was no need, sir. Because there was no need. So that is what the Keynes has tried to explain. He says with more money in hand, obviously you will have more spending, right? But the rate of consumption or the rate of spending will not be same as the rate of increase in income. Clear? So I've given you sufficient examples now to understand this thing. Okay, the next topic, I hope this consumption function is absolutely clear, because based on this we will be moving on to the marginal propensity to consume. So this is another topic now, marginal propensity to consume. What is that? MPC describes the relationship between the change in consumption and the change in the level of income. Basically what is there? This is this particular B part. This is your MPC. Right? MPC shows the change in consumption due to the change in income. Right? If we talk about here, this change in income is 50,000. What is the change in consumption? MPC is what? MPC is change in consumption due to change in income. Right? So 5,000 divided by 50,000, that becomes your marginal propensity to consume. Let's see here. If the income of an individual increases, his or her consumption expenditure will also increase. That we have understood, right? For example, if the income of Harsh increases from 10,000 to 20,000, right? His consumption expenditure will also increase because he now has more money in hand for expenditure. That is but obvious, right? However, the rate of change in the consumption expenditure may not be equal to the rate of change in the level of income, because at higher levels of income, people will start saving more because they know there is no need to spend more. Now, what will happen? Your income increased by 50,000. It is not necessary that you will have to spend 50,000 rupees. You can spend additional 5,000 and remaining 45,000 you can do what? You can absolutely save. And that's what people do. As the income keeps on increasing, the rate of consumption expenditure is not that much. People start saving then, right? Now you are able to save. At the first level, let's see here, 1,000, you are not able to save. As your income increased to 2,000, your expenditure just increased by 500, right? And what about the remaining 500? The remaining 500 people will save. You will save here. Clear? So he says the value of increment to consumption expenditure per unit of increment to income is termed as value of increment of the consumption expenditure per unit of increment to income is termed as marginal propensity to consume, which is denoted by MPC is equal to delta C, that is the change in consumption expenditure due to change in income, that is denoted by B, as we have already discussed. That is the slope. How much is the change in consumption? This consumption expenditure will increase, but how much is the change as you increase the income, right? But how much will be the change? That is studied through MPC. MPC tends to decline at higher levels of income due to more savings than consumption. Tends to decline means the slope will not be that much, right? The slope will keep on declining as the income increases, because with the increase in more and more of income, it can never be zero, right? Always remember one thing, the consumption can never be zero. That is what we have studied. That is why this A is there, right? Even if the level of income is zero, there will be some consumption expenditure, but he says as you keep on increasing the income, the consumption will increase, but the rate will not be that much, right? At higher levels of income, people will start saving more and consumption expenditure will be lower and lower. That will be the minimum that is required. So that is your marginal propensity to consume. Another topic that comes to our mind is average propensity to consume. What is average propensity? APC describes the relationship between the total consumption and the total income. It shows what proportion of total income is spent on consumption of goods and services and what proportion is saved. Which goods and services? We are just talking about consumer goods, right? Because investment goods, that is once in a while. Right, so APC tells us the average propensity to consume tells us that out of the total income, let's say there is a person, right, Ram, who is earning 10,000 rupees and he is spending 8,000 out of it. So APC will tell us that out of the total income, what part of the income that Ram is ready to spend. Out of the total income, what part of the income the Ram is ready to spend on the consumption of consumer goods. Clear? So at zero level of income, there will be some consumption expenditure, and as such, APC will be infinite. We'll do it with the practical problem, right? We'll try to understand. APC will keep on declining with the increasing levels of income as the consumption will decline at higher levels and the people tend to save some part of their income, right? At higher levels, this consumption will be less and this income will be high. So APC will keep on declining. Let's try to understand with this table. Just pay attention and try to understand with the help of this table. This income, Y is your income, C is your consumption, this is your APC, that is the average propensity to consume. This is the marginal propensity to consume. Forget about this MPS for now, because MPS will be taking up in the next lecture. Okay. Now we say, let's say your income is zero. At zero income, there will be some consumption expenditure which is denoted by A. Isn't it? At zero income, we say even if your income is zero, you will need food, right? For that, you will have the consumption expenditure that is denoted by A. What is APC now? APC is out of the total income of zero, you are spending 500 rupees. This becomes infinite. Will there be any MPC? No, sir. There will be no MPC, right? Now, let's say your income increased by 1000 rupees. Now your consumption expenditure has also increased, but your consumption expenditure has increased by what? Your consumption expenditure has increased by 750, right? That is what we say, that as your income increases, the rate of increase in the consumption will not be the same. Now, what is APC here? The APC is you are spending 1250 out of your income of 1000. That is, this is a situation where you are spending more than your income. Right? This is a situation where you are spending more than your income. Okay, what will be the MPC here? MPC is the change in the consumption due to the change in the what? Income. So it becomes 0.75. So earlier the MPC was 0, right? It has increased now to 0.75. So as the income increased, the MPC also started increasing. Now, again, your income has increased by 1000 rupees. And what is the change in the consumption expenditure? What is the change in the consumption expenditure? That is again 750. Now, what is APC? So this is the level where you are spending everything that you are earning. You are earning 2000 rupees and you are spending 2000 rupees. So what is APC? APC here is 1. Right? And what is MPC? MPC remains same. That is 750 divided by the change in income, 0.75. Right? Then again, your income increased by 1000 rupees, your consumption increased by 750. Now, what is APC here? Average propensity. You are earning 3000 rupees and you are spending 2750 out of it. Let's see, try to understand here now what is happening. Sir, your income is increasing, right? But your consumption started falling. First was the case where at zero level you are doing the consumption, that is understandable. Now you started earning 1000 rupees, right? You are an article assistant, you are getting a stipend of 1000 rupees, but still you have an income of 1250, expenditure of 1250. Then there comes a situation where you are earning 2000 rupees and you have an expenditure of 2000 rupees where the APC is 1. Everything that you are earning, you are spending. Now, as your income increased further to 3000, you started saving some money, right? And what are you spending? You are spending just 2750 rupees and the rest you are saving. That is what they say. That is what we are saying, that as APC will keep on declining, APC will keep on declining with the increasing levels of income as the consumption will decline. So what is happening here? The consumption is declining. Now the consumption is less than what you are earning and you are saving something. Sir, what about the MPC? 0.75. Now your income increased by 3000 rupees, but your expenditure is increasing by 2250, right? So out of total 6000 rupees, you are spending 5000. You are again what? You are doing 83% expenditure. Earlier you were doing 100% expenditure, then 92% expenditure, then 83%. The APC is declining. Your consumption expenditure is declining. Why? Because as your income is increasing, you are satisfied. You say, now I don't need much of it. I can save some money, right? You start saving. What is MPC? MPC will remain same. Now your income increased by 4000 rupees, your expenditure increased by 3000 rupees. Out of 10,000 rupees, you are spending only 80%. Further decline, 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 right? MPC remains the same. Now, your question here is that why, sir, MPC remains same? Sir, MPC will increase. Try to understand, MPC will increase, but it will remain constant. Why? Otherwise, this will not be a straight line. Otherwise, it will not be a straight line. What it will be, if this MPC doesn't remain same, then this will be like this, isn't it? So the MPC will increase, will definitely increase. Your marginal propensity to consume will increase with the income, but it will remain constant. It will remain 0.75 at every level, right? So that you get a linear function, a straight line. Right? I hope with this example, the concept of APC and MPC is clear. MPC talks about the change, right? The change in consumption due to change in income. APC talks about that what you are ready to consume, what you are ready to do, how much of the consumption expenditure you are ready to do out of the total income that you are earning. So this is the difference between MPC and APC. Clear? So in this part, what we have done is we have done the consumption expenditure, this consumption function, which is a function of income. And I have told you these things. Please remember this thing, that Y is equal to YD, that the total income is equal to total disposable income, and the consumption will depend upon whatever the disposable income you have in hand. Clear? So what you have to do is revise this thing, right? Whatever we have done till this point in the books, it is still 2.5 page that we have done, 2.6 half page we have done. And in the next lecture, we'll be starting with this saving function, very similar to the consumption function, but very, very important. Then we will move on to the equilibrium income in the two sector model, then investment multiplier, then 3 and 4 sector model, right? We'll try to wrap it up as soon as possible. For that, what you have to do is you have to revise side by side. Whatever we are doing, as soon as the lecture is over, revise it from the books, right? That is why I provided this books in a very simplified way, so that even if you are revising the next day, it will just take 5 to 10 minutes to revise each and everything, because everything is given in the precise pointer forms, right? Rather than it is difficult to read it from the ICAI material. If you are doing it, that is absolutely fine. That is totally your choice, right? So see you guys in the next lecture. Till then, stay safe, stay healthy, keep studying, keep sharing. Thank you so much.